Now, all this buying and selling leads me on to mistake number 2, which is market timing. We've all worked hard for our money, so it is natural that we all want to protect our money, right? When markets are going down, you want to try and predict what's going to happen and you want to sort of limit your losses. Unfortunately, as this slide shows, is that investors are really poor at timing market cycles when deploying capital. There was a study, JP Morgan actually did this study, and this is probably one of my favourite charts. What it shows is, on the far left, is an investor investing in the stock market, holding their investment for a 20-year period ending 2016. This investor does nothing. They invest and hold their investment. You know what their return is? Just under 8% or 7.7% per annum. Contrast that to the investor who bought and sold and during that process missed the 10 best days in 20 years. So the 10 best days in 20 years, they missed those 10 best days. And the reason why they miss those 10 days is typically you'll find the best days follow the worst days. In fact, 6 of the 10 best days over the last 20 years occurred within 2 weeks of the 10 worst days. I mean, I don't know how you think you're going to try and avoid those days and then participate in the upside at the same time. What happened to that investor? Their return was halved, 4%. This guy did nothing. He went fishing for 20 years, came back and he's earning 7.7% per annum during that time. And your return just gets worse from there once you miss the 20 best days, 30, 40, 50, 60 best days, and it just goes on from there. Unfortunately, more money is lost in trying to avoid some sort of crisis than the crisis itself, as you can see here on the far left. Let's say you invested $10,000 into the stock market 20 years ago. If you had simply taken the long view and remained invested during that time, your portfolio would be worth around $50,000 today. If, however, you attempted to time the market, you exited and entered at what you thought would be the right time, and during that course of events, you missed the 10 best days over that 20-year time frame in the market, the 10 best days. Your portfolio today would be worth $25,000, half of what it otherwise would have been if you simply stayed the course. The stress, the worry, the frustration, the time spent in researching your exit and entry points resulted in an enormous destruction of your wealth. Was it really worth it? Stop trying to time the market.